Can you trade options with a $5,000 account? And if so, how would we do it? If not, why not? We're going to answer all of that in this video today about trading options with a $5,000 account. What's up, everyone? Erik here from Outlier Trading. Options is pretty much what I do. I've been trading options most of my life. So we are going to dive into some of the nuances here. I'm going to talk to you a little bit about the landscape of trading options, what some goals might be for an account this size, and some strategies to at least give you an idea on where you can start learning. So before we get too far, you already know we got to start with a disclaimer. I am not a part of Barchart. I simply enjoy creating content with them for you, nor am I a financial advisor. I'm just a dude online talking about trading. So you should do your own due diligence. Okay. Let's start with an orientation. The world of trading options is really nuanced. And as soon as we start trading options, we add complexity. Now, this is not an intro to options trading video. You can actually hop over to Barchart for content like that. They have a really great section under the Learn tab where you can learn the basics of options trading. You can look at all different kinds of standard educational components about individual strategies and things like that. So highly, highly recommend if you're brand new to options trading to peruse through this. There's a lot of great materials there. So options do add complexity. It's one of the benefits of trading options. One of the things to keep in mind is if we're starting with a $5,000 account, which in the trading world is a very small account, you are severely disadvantaged for a lot of different reasons. And it's not that the market doesn't like you. The market is indifferent to you. It's disadvantaged in the fact that it's really difficult to put on trades and not be oversized immediately. A lot of times we want to manage a portfolio different ways, depending on what your methodology is. But more often than not, if you're trading an individual stock, we don't tend to want to be all invested in one stock, which is kind of easy to happen with a smaller account like this. So there's going to be some tools and tactics we can use to avoid that scenario, but we have to be aware of it. Options can hurt you. And what I mean by that is because of the complexity, there are a lot of small things you can step in front of without even knowing. It's that saying of, we don't know what we don't know. So say, for example, you're looking to sell your first credit spread. You find something that you like. It's liquid. You go through all the standard checklist items. You put your trade on, and the next day it moves huge, and you end up taking a max loss. And then you find out it had earnings the next day, and you just didn't know that earnings can do that and that you probably needed to look for earnings ahead of time. Well, that's a lesson learned, but that's also money lost to learn that lesson. So with trading, we have to try and learn as much as we can by not losing money, but by learning from other people's mistakes or conversations with other people. And then through things like paper trading, which gets a bad rap, but it's really, really great to help learn, because what I can tell you is a $5,000 account does not have many mistakes available before you draw that account down too far. So that means we have to take our time learning options because they are complex. Trading is really misleading in that way because you can start trading options knowing nothing about it. You don't have to pass a test. It's not like driving where you have to learn how to drive and then pass a driver's test. There's none of that. You can just open up an account and start moving trades. And there's no vetting process, which again is why I really, really recommend going through Barchart's Learning Center here. And then you can use this to help you learn about the individual concepts. But then more importantly than that, you can then go into something like ChatGPT and ask it to quiz you so that you can create your own test for yourself. This is literally to make sure that you are not making unnecessary mistakes and losing money. And the last note here is options are quite literally terrible for get rich quick schemes. Meaning if you think that you're going to trade options and just make a bunch of money super fast, you're probably going to be sorely mistaken. The overwhelming probability there is actually that you'll just watch your money vanish. And you can look at different studies that talk about retail options trading behavior and tendencies. So just to be aware of that. All right, so now let's get into what some of our goals might be. And I want to start with things that you might want to consider to do. So the first one is save your money. I know it's not trading options with a $5,000 account, but it is the ultimate enabler. The reality of you trading a $5,000 account into your future wealth without adding any money whatsoever is about null, meaning it's so unlikely. Now, you could try to go that route if you're so inclined. It's up to you, make the decisions for yourself. But the probability of that happening, especially as a new trader, is exceedingly low. So saving is super, super important. What we should be doing with a $5,000 account is focusing on learning how options behave, building an approach, and prioritizing a trading process. Because ideally, trading is a really long-term thing that can last a very, very long time. So if we're smart and judicious about our approach, then what we're really doing with a $5,000 account is learning with a low-risk scenario. And rather than trying to focus on turning this $5,000 account into millions, which again, very unlikely, we should be focusing on learning how options behave, how we can build a personalized approach, and what kind of process makes sense for us as individual traders, because it's a very, very individualized process. Now let's take a peek at what we should not do. The very first one is what we already covered. If you approach this $5,000 account thinking that you're going to turn this into massive amounts of money, that's going to require you to take an inordinate amount of risk that you're probably not going to learn anything from, because you're just going to be taking really, really large positions relative to the account size and probably blow up pretty fast. So I think I've made that point abundantly clear by now. These last two things are actually really important though, because the overall effort that goes into building a customized approach and defining a process is not insignificant. That's really where the work of trading is done. So when I say move haphazardly, what I mean is if you're trading this $5,000 account and Monday you're selling credit spreads, Tuesday you're going into debit spreads, Wednesday you're trading ratio diagonals, Thursday you're trading a covered strangle, and you're not really tracking anything, you're just kind of bouncing around between all these random things, you're going to have very little to show for it. That leads to the third item here, which being lazy in trading shows up in a lot of different ways, but I mostly mean in terms of your trading documentation. This $5,000 account is the perfect size account to learn how to build a trading plan, to learn how to build a trading log that helps validate and quantify what your plan says. This is a fantastic way to learn the approach and methodologies of trading. This is a poor way to grow a bunch of money from a small account. So keep that in mind as we move into some strategies. Now, the first strategy, vertical spreads. This can be debit or credit spreads. And let's take a look at those. One of the things you will notice is that with a small account, you're going to be limited in terms of what you can trade. But the beautiful thing about vertical spreads is they are kind of an equalizer. They define your risk right out of the gate. So let's say that you came across JetBlue after popping into Barchart, and you can run a scan. In this scan, what I did was look for stocks that have been going up, that have decent open interest for a small account, meaning you don't need a ton of liquidity, that it has options, and the last trading price was no more than $15. We have to keep it cheap. Now, for vertical spreads, realistically, anything becomes more accessible, but I'm using this as a starting example. Then we can check out the results and we can just poke through this list and see what looks really good to us. So we come across JetBlue, maybe we're bullish. So I have built a few different trades. If we're bullish, we can do something like sell a put spread. And you'll notice that it is defined risk, $77, but defined profit of only $23. The problem with vertical spreads is that you're really not going to have a whole lot to show for them. Meaning, if we look at the call, let me grab the call vertical spread here. And you can see that you can make $85. You're only risking 15, but it's a low probability trade. So with the numbers that I'm showing you, You can make 85 bucks, which is great. That's fine. But you're risking 15, which is also fine. But those aren't really going to move the needle a whole lot. So vertical spreads are a great way to get your feet wet and learn how options behave by doing, but not exposing yourself to a ton of risk. And a normal way to trade something like this is we would look at something that is around a 30 delta for the short option if we're selling the vertical, and then you can buy something that's $1 wide, $2 wide, whatever you're comfortable to cap the risk. And then if you're buying, a lot of times we would buy something that's closer to at the money and in the money slightly. Really, really common. You can tinker with different kinds, maybe in a paper trading account, and see what you like. So vertical spreads, accessible. Ratio diagonals add a little bit of complexity because now we're adding individual trade legs. So we can trade ratio put or call diagonals. Ratio call diagonals are built for the upside. So let's take a look at one of those. The base position in a ratio diagonal is a longer dated, typically at least 90 days, long option. In this case, I'm using an 8 call out in June 25, and I'm paying $1.24. So again, the reason why we're using cheaper stocks here is because I can buy multiple contracts and still be within general budget. You'll have to define for you what risk per trade makes the most sense. But a lot of times people will want to stay below 2%, 3%. On smaller accounts, you're naturally going to be a little bit higher on that range. Larger accounts will be 0.25% or even 0.5%. So it depends on the strategy as well. You can't really apply blanket rules like that to everything because we really care about expected return, which is a different approach to sizing trades. But take a look. We buy one of these for $1.24, which is $124, the long option. Then we can buy a second one. That brings us to $2.48. So that takes us to a slightly oversized position relative to what we're trying to trade. But again, that takes us to about 5% total portfolio risk in this one trade, but it can be managed. We don't have to let this come to a full loss. Then what we do is we actually sell a nearer term option against it at a ratio. So in this case, we're long 2 of the 8 calls in 20 Jan, but then we sell 1 of the 8.5 calls in 31 Jan. And notice how it creates this really nice positive sloping. We're not capping our risk like a normal diagonal does. If I give you an example of the normal diagonal, which is at a 1-to-1, notice how we actually have upside risk. You can be too right, which is kind of annoying. This is a really capital efficient strategy. It's kind of like a way of trading a ratio covered call or a standard covered call. I emphasize the ratio because I don't like capping my upside potential, but you can do this also on the put side. The last two, I'm going to go over super quickly. A covered strangle is really difficult to trade in a $5,000 account, but the way it would work is like this. First, we would buy at least 100 shares. For this example, I'm using 125 shares, and you'll see why. So we're buying shares outright. Then we sell a strangle that's really whatever standard DTE you prefer. In this case, I'm using the 21 Febs. And there are 29 delta on both sides for the call and the put. And that gives you this. So the put side is designed to be cash secured. So on the 9 put, you're putting up $900. You're ready to take assignment on those shares. To get into this trade originally from the onset, you're already in for 1663, which is really significant relative to the size of the portfolio. So this would require careful management, meaning we can't allow the size of the trade to be the total risk. We would have to define somewhere that we would say we are wrong. Maybe if it falls below a 50-day moving average at 671, we can then see what would our loss be at 671. And in this case, it puts us at like $145. That's okay. That's completely within tolerance, and we're okay with that. And you can even open it up a bit further, right? So we can take maybe $500 loss. It's a little too big for a $5,000 account. So we want to keep it around 250, something like that. So maybe 586 or something in there based on your technical analysis. And then we sell the call. The purpose of the call is to take in a little more premium, but notice how we keep a ratio. We have 125 long shares against 1 short call, which is why we don't have capped profit potential. To show you what it would look like if we just had 100 shares against the short call, this. Notice how the profit taps. We don't want that. It's not the end of the world, but try to prevent it. And then singles. This is essentially a variation of how I would trade ratio diagonals, but it just, instead of selling the option as part of the trade, we would just not sell the other option and we would just buy the option itself. Now, the way to think about single options, in my opinion, is when we're buying them, it's essentially designed to be a stock replacement. So we want to trade it as if we're applying our standard stock methodology. We don't want to come in super far in time and just YOLO super far out of the money calls and hope something hits. Not at all how it works. And there's actually a couple videos that I've done about buying call options smarter, because one of the common misconceptions is that when you buy a call, the underlying has to go to your strike in order to make money, which is not the case. You can buy an option that's already in the money or closer to the money, and we are using delta. So if I go back to the long option that I was explaining before as part of the ratio call diagonal, the 8 calls in 20 June, and our strike price is 8. And the current price of JetBlue is $7.71. So if we take a look, let's say before 8, let's say we take a look at $7.90. Notice how I'm making $8.99. It's not beyond my strike yet, but I'm making money. That's because of delta. Now, this will decay, so you need to move in a certain amount of time, which is typically why I personally like to go further out in time. It slows down theta decay. And if you're interested, we can do a follow-on video on how to buy call options in small accounts. As always, if you need anything, throw it in the comments. Be an outlier. See y'all later.